Something unprecedented just unfolded in precious metals, and most traders completely missed it. While Western markets were dark, the real price of silver revealed itself in Shanghai. That price is $7 higher than what your broker shows. I'm going to explain why this gap exists and what it means. Subscribe and turn on notifications if you want truth instead of mainstream narratives. This could be the most important market development you learn about this year. Let me know in the comments if you're ready to act or if you're still researching. During the holiday season, while you enjoyed festivities, something remarkable occurred. Western trading floors sat empty and dormant, yet across the Pacific, the Shanghai Gold Exchange, Earth's largest physical silver marketplace, documented a transaction that should concern everyone. Physical silver exchanged hands at $82 per ounce. This wasn't theoretical. This wasn't derivatives. Actual metal transferred ownership at that figure. Meanwhile, every Western screen displayed $74.87. Kitco showed it. Bloomberg confirmed it. Your investment platform agreed. A $7 chasm existed between Shanghai's reality and Western perception. This divide will either create fortunes or obliterate portfolios completely. Before proceeding further, understand this clearly. Nothing presented constitutes investment guidance. You bear full responsibility for financial choices. Conduct independent investigation. Consult qualified experts. Never risk funds essential for survival. My purpose involves revealing market mechanics obscured from public view. Why does this $7 discrepancy exist? Most investors misunderstand precious metals operations. These markets function continuously, but not uniformly. The COMEX in New York dominates price discovery for silver. Futures trading establishes benchmark values. Christmas Day shut down COMEX completely. London's LBMA closed simultaneously. For 36 consecutive hours, Shanghai stood alone as the sole major venue actively exchanging physical silver. During that window, absent Western banking interference, absent algorithmic suppression, absent typical paper contract manipulation, genuine physical silver pricing emerged naked and undeniable. $82. That represents real cost when acquiring actual metal, not shuffling contracts electronically. Consider Monday's opening bell. That $7 void must resolve somehow. Two paths exist, both carrying massive implications. Should Western quotations surge $7 upward matching Shanghai, every trader positioned against silver faces margin liquidation. Forced purchasing on enormous scale could potentially drive silver toward $90 or beyond within hours. However, the alternative scenario destroys wealth. If COMEX launches with massive paper contract dumping, if major commercial institutions flood markets with selling pressure forcing quotations downward, Shanghai must follow. Everyone who purchased physical metal in China at $82 suddenly holds inventory worth less than purchase price. That's the Monday danger. You won't identify which direction the gap closes until reaction becomes impossible. This $82 Shanghai print wasn't random occurrence. Pressure built for months, approaching critical breaking point. Silver gained 158% throughout 2025, the largest annual increase since 1979. We're witnessing the biggest movement in 46 years. This transcends typical bull markets. Fundamental market architecture is shifting. Physical supply collapsed entirely. Shanghai Futures Exchange warehouses currently store merely 531,000 kilograms of silver. That's the lowest stockpile witnessed across a decade. The U.S. Mint exhausted silver coin inventory. The Royal Canadian Mint cannot maintain silver bar availability. Dealers throughout North America operate under allocation for weeks, literally unable to obtain metal for customer sales regardless of demand. Industrial purchasers cannot cease buying silver. Solar panel manufacturers require it. Electric vehicle producers depend on it. AI data center construction demands it. These corporations cannot postpone purchases awaiting lower quotations because delays halt production completely. Economists label this inelastic demand. When silver traded at $30, Tesla acquired it. At $50, purchases continued. At $75, acquisition accelerated. At Shanghai's $82, buying intensified further because these companies recognize something critical. Supply won't return. Within 1 week, January 1st, 2026, brings China's most restrictive silver export regulations in modern history. Any enterprise selling silver internationally must demonstrate annual production capacity exceeding 80 tons. Most smaller refineries and merchants cannot satisfy that threshold. Complete lockout from export markets results. The outcome is straightforward and alarming. Chinese silver remains in China. Global supply just decreased 70%. China controls 70% of worldwide refined silver production. When export restrictions activate, remaining nations compete for leftover 30%. That fraction already serves existing contracts, industrial commitments, and governmental reserves. Nothing remains for retail purchasers. Nothing exists for individuals who awaken January 2nd deciding to acquire silver. When observing Shanghai's $82 quotation, you're not seeing a bubble. You're witnessing early price discovery in a market recognizing supply disappearance. Western markets haven't incorporated this reality because Western markets were dark. Shanghai operated fully aware, revealing silver's actual cost when alternative sources vanish. Understanding Monday's potential violence requires grasping a technical concept, backwardation. Normal commodity markets price futures higher than spot. This makes logical sense. Agreeing to deliver silver 6 months forward costs more than today's price due to storage, insurance, and financing expenses. That premium for future delivery, called contango, represents normal market conditions. When markets enter backwardation, everything reverses. Spot price for immediate delivery exceeds futures pricing. That's abnormal. That signals extreme stress. People willingly pay more for silver today than for promises of silver 6 months forward. They distrust the promise. They doubt silver will actually exist in 6 months. Silver remained in backwardation throughout China for weeks. Despite $7 premium over COMEX futures, buyers continued paying. They pay $80 for silver held immediately rather than $75 for potential March delivery. That reveals everything about confidence levels. The physical market distrusts paper market delivery capabilities. Circumstances grow suspicious. Thanksgiving night, November 28, 2025, CME Group, operating the COMEX Futures Exchange, experienced what they termed a cooling system failure at their Illinois data center. Silver futures trading halted exceeding 11 hours. 11 hours during a massive rally. They attributed it to air conditioning malfunction. That identical morning, the Federal Reserve executed an emergency repo operation, injecting $24.4 billion liquidity into the banking system. $24 billion on the Friday following Thanksgiving, one of the year's quietest trading sessions. Why? Banks needed immediate cash covering margin calls. Market speculation suggests a large Asian buyer, probably Chinese, ordered massive physical delivery from COMEX, and the exchange couldn't fulfill delivery. So they shut down markets, arranged emergency calls, secured emergency liquidity, and reopened 11 hours later, blaming cooling systems. Whether accurate or not, the fact this scenario seems plausible reveals system fragility. Futures markets assume most contracts settle through cash, not metal delivery. If excessive physical delivery demands emerge, the entire system fractures. Thanksgiving night nearly witnessed that fracture. 1 month passed since that event. Silver climbed from $60 to $75 in the West and $80 in Shanghai. Pressure intensified, inventory declined further. We're approaching Monday morning where Western traders observe that $7 gap and make instant choices. Do they chase prices higher? Attempt shorting it downward? Panic? Here's my projection. COMEX opens with violent upward gap. Silver rips towards $78 or $79 within the first trading hour as algorithmic systems reconcile Shanghai pricing. That triggers cascading buy stops and short covering, pushing us toward $82 in New York by midday Monday. Once the West officially acknowledges $82 as genuine pricing, we don't stop there. We push toward $85, then $90, because industrial buyers who waited hoping for pullbacks realize the pullback never arrives. But here's the danger. If I'm incorrect, if commercial banks possess sufficient power smashing prices back down, if they dump enough paper contracts forcing a sell-off, then everyone who bought at $80 in Shanghai holds underwater positions. Everyone purchasing the gap up Monday morning gets stopped out and loses money. That's the hazard. You're betting the physical market wins. You're betting the paper market finally lost control. If wrong, you get crushed. What should you do? If you already own physical silver, do nothing. Hold. This isn't selling time. If silver reaches $90 or $100, you want ownership. If it pulls back to $70, you still want ownership because this represents a long-term structural movement. The supply deficit is genuine. Industrial demand is genuine. Chinese export restrictions are genuine. This situation doesn't simply vanish. If you don't own silver yet, if you're holding cash awaiting a dip, understand something crucial. The dip might not materialize. We might gap from $75 to $85 and never retreat. If that happens, if you miss this movement because you awaited $70 or $65, you'll chase it at $100. The optimal time for buying was 6 months prior. The second optimal time is immediately. But if you wait until Monday and attempt buying into the gap up, you're purchasing at the worst possible moment, precisely when the trap is most dangerous. Let me discuss mining companies because huge opportunity exists here. If you cannot obtain physical silver, if dealers are sold out or charging insane premiums, the next best option involves owning production companies. At $75 silver, profit margins for silver miners are absolutely massive. A typical primary silver miner has all-in sustaining costs around $20 per ounce. That includes mining, refining, overhead, everything. At $30 silver, they were barely profitable. At $50 silver, they were doing okay. At $75 silver, they're printing money. At $82 silver, they're making 60 to profit per ounce. Consider what that does to their stock valuation. A miner producing 10 million ounces annually just went from making $80 million profit at $30 silver to making $600 million profit at $82 silver. That's a 7 times increase in earnings. But have their stock prices increased 7 times? No. Most have doubled or tripled, but they haven't repriced to the new reality yet. The market remains skeptical, still waiting to see if this price is real. But once Monday morning's gap confirms that $82 is the floor, once the West admits Shanghai is correct, those mining stocks are going to explode. The beautiful thing about miners is they're liquid. You can buy them, you can sell them. You're not dealing with premiums or shipping delays or storage fees. You just click a button and own a piece of a silver mine generating $60 per ounce in free cash flow. But you have to be selective. Not all miners are equal. You need ones that are unhedged, meaning they haven't locked in future sales at lower prices. You need ones in safe jurisdictions because if silver hits $100, governments will start talking about windfall taxes or nationalization. And you need ones with low debt because high leverage works both ways. If silver pulls back, leveraged miners get destroyed. Now let's discuss what happens if I'm correct. If silver gaps up Monday and holds above $80, what comes next? I think we're looking at a 3-stage movement. Stage 1 is gap fill and confirmation. That's Monday through Wednesday. We gap from $75 to $80, maybe $80. We consolidate and hold. The shorts cover, algorithms recalibrate. By Wednesday, $80 is the new floor. Stage 2 is industrial panic. That's the remainder of December into January. Chinese export restrictions go live. Supply tightness becomes undeniable. Industrial buyers who thought they could wait start placing orders at any price. We grind from $80 to $90, then $90 to $95. This stage is slower, not a panic spike, just relentless buying with no sellers. Stage 3 is public mania. That's when silver breaks $100 and makes the front page of every financial news site. That's when your uncle, who hasn't thought about silver since 2011, calls asking if he should buy. That's when ETFs see massive inflows. That's when momentum traders pile in, and that's when we go from $100 to $120, maybe $150 in weeks. But here's the thing about stage 3. By the time it happens, you're not buying anymore. You're selling, or more accurately, you're swapping. You're taking your silver and trading it for something productive. Real estate, a business, or gold at a favorable ratio. You're not selling it for dollars, because by the time silver's at $150, the dollar is in free fall. That's why silver is at $150. You don't trade the hardest asset for the softest currency. You trade it for another hard asset. The gold to silver ratio right now is about 60 to 1. That means it takes 60 ounces of silver to buy 1 ounce of gold. Historically, that ratio has gone as low as 15 to 1 during silver manias. If we get back to 30 to 1, which I think is very possible, you can swap your silver stack for twice as much gold as you can today. That's the trade. You ride silver up, swap into gold at the peak, preserve your wealth without ever touching fiat currency. Now, let's talk about the elephant in the room. What will the government do? Because make no mistake, if silver goes to $100, if it disrupts industrial supply chains, if it creates a financial crisis for banks that are short, the government will intervene. They have to. They can't let a commodity market blow up the derivatives complex. So what tools do they have? First, they can raise margin requirements on futures contracts. They've done this before. In 1980, when the Hunt brothers tried to corner the silver market, COMEX raised margins to 100%. You had to put up the full value of the contract just to hold the position. That killed the rally and forced liquidation. They'll do it again if necessary. Second, they can implement position limits. They can say no single entity can hold more than a certain number of contracts. This prevents hoarding and short squeezes. It gives commercials breathing room. It's a blunt tool, but it works. Third, they can declare force majeure. This is the nuclear option. The exchange or clearinghouse declares that due to extraordinary circumstances, they cannot fulfill their obligations. Contracts get settled in cash at a price they determine, not the market price. If you're long silver at $100 and they declare force majeure and settle you out at $80, you just lost 20% and there's nothing you can do. This is why physical silver in your possession is so critical. They can manipulate the paper price. They can change futures exchange rules. They can halt trading. They can force cash settlement, but they cannot take metal out of your safe. If you hold it, you own it. When the dust settles, when contracts are unwound and lawsuits are filed and new rules are written, the person holding physical metal wins. Now, I want to address something I keep seeing everywhere. People asking, should I wait for a pullback? Should I wait for silver to come back down to $70 or $65 before buying? I understand the logic. Nobody wants to buy the top. Nobody wants to buy at $82 and watch it drop to $70. But here's what you're not considering. What if it doesn't pull back? What if Monday gaps up and we never see $75 again? Think about it. Shanghai's price is $80. Western price is $75. That gap has to close. It closes by Shanghai coming down or New York going up. If you're waiting for a pullback, you're betting Shanghai comes down. You're betting Chinese buyers suddenly lose interest. That industrial demand evaporates. That export restrictions don't matter. Do you really think that's happening? Or is it more likely New York catches up to Shanghai? That Western traders wake up Monday and realize they've been wrong, that the paper price has been suppressed, that the real price is $82 and going higher. If that's what happens, and I think it is, then waiting for a pullback is the same as waiting to miss the move entirely. Let me tell you what happened in 2020. Silver was trading at $12 in March of 2020. Refineries shut down because of COVID. Physical premiums exploded. You couldn't buy a Silver Eagle for less than $20 even though spot price said $15. People waited for premiums to come down. They waited for the market to normalize. By the time it did, spot was at $30. The pullback never came. People who waited paid double. This is the same setup, but bigger. Refineries aren't shut down because of a virus. They're shut down because there's no metal. Premiums aren't high because of temporary demand. They're high because of structural deficit. And the gap between physical and paper isn't $2. It's $7. If you wait, you're going to pay more, not less. Now, I want to be very clear about something. I'm not telling you to buy silver. I'm not your financial advisor. I don't know your situation or risk tolerance. What I am doing is laying out facts as I see them and explaining the mechanics of what's happening. You have to make your own decision. Always do your own research. Consult with qualified professionals. Never invest money you can't afford to lose. But if you're asking what I would do, here it is. If I didn't own any silver, I'd be buying right now. Not all at once, not going all in at $75, but scaling in, buying a little bit every day regardless of price, because I believe the trend is up. And I believe the risk of missing the move is greater than the risk of a short-term pullback. If I already owned silver, I wouldn't be selling. I'd be holding and being patient, because even if we pull back to $70, even if Monday is a disaster and the gap closes down instead of up, the long-term trajectory is clear. The supply deficit is real. Industrial demand is real. Chinese restrictions are real. This is a multi-year bull market, and we're still in early stages. And if I was looking for leverage, if I wanted to amplify returns, I'd be looking at miners. Not ETFs, not junior explorers with no revenue. I'd be looking at established producers with low costs, strong balance sheets, and exposure to rising silver prices. Because when this really gets going, when we're at $100 silver and mainstream media finally pays attention, those stocks could be up 500 to 1,000%. Let me paint you a picture of Monday morning. You wake up and check your phone. Silver is trading at $78 in pre-market. It gapped up $3 overnight. You're excited, nervous, wondering if you should buy. By the time markets officially open, it's at $80. Momentum is building. Shorts are covering. Algorithms are chasing. Within an hour, it's at $82, matching Shanghai's price. Now the question is, does it stop there or keep going? If it stops, if $80 is the top and we spend days consolidating, then okay, you have time. You can wait and watch. But if it doesn't stop, if it blows through $82 and hits $85 by lunch, then you're chasing. And chasing is how you lose money. The trap is not knowing which scenario plays out until it's too late. That's why it's called the Monday morning trap. The decision you make in the first hour of trading could define your next 12 months. Do you buy into strength and risk a pullback? Do you wait and risk missing the move? There's no perfect answer, only the choice you make and consequences that follow. What I can tell you is this. People who win in markets like this aren't the ones who time the bottom perfectly. They're the ones who recognize the trend early and have courage to act on it. Silver at $75 is expensive compared to 6 months ago, but it's cheap compared to where it's going 6 months from now. The question is whether you believe that, and if you believe it, whether you're willing to act on it. We're living through the greatest wealth transfer in modern history. The currency system is failing, paper markets are breaking, physical assets are becoming unobtainable. People who understand what's happening, who position themselves correctly, are going to come out wealthier than they imagined. But people who sit on the sidelines, who wait for permission, who need absolute certainty before acting, they're going to be left behind. Silver hit $82 while markets were closed. That's not a headline, that's a signal. It's a message from the physical market to the paper market saying, We don't care what your algorithms think silver is worth. We know what it costs to get it, and the cost is $82. The question now is whether the paper market accepts that message or fights it. My guess is they fight. They'll try to smash it back down. They'll flood the market with sell orders. They'll raise margins. They'll do everything to regain control. But I don't think it works this time. Physical demand is too strong. Supply deficit is too severe. Chinese restrictions are too binding. And when the paper market finally admits defeat, when they accept that $82 is the floor and not the ceiling, that's when this goes parabolic. That's when we go from $82 to $90 to $100 in weeks. And if you're not positioned by then, you're not getting positioned, because once mania starts, once the public piles in, premiums go insane. You'll be paying $120 for a silver eagle when spot is at $100. The window closes fast. Here's what you need to understand. The Monday morning trap isn't just about Monday. It's about the entire next phase of this bull market. It's about whether you recognize what's happening and act accordingly, or whether you hesitate and miss it. People who bought at 25 and held through volatility are sitting on 300% gains. People who waited for a pullback that never came are still waiting. Don't be the person still waiting when silver is at $150. Don't be the person who looks back in 2 years and says, I knew it was going up, but I didn't buy. Because that regret is worse than any short-term loss. You can recover from buying at the wrong price. You can't recover from not buying at all. The choice is yours. The information is in front of you. The mechanics are clear. The catalysts are real. What you do with that information is up to you. But whatever you decide, decide fast, because Monday morning is coming, and when it does, the trap snaps shut.